Hello, everyone, and welcome to the NextGen Planners podcast. My name is Dan, and I'm the head of community experience here at NextGen Planners. And today, I'm joined just by someone from just down the road. We could have just done this in person instead of doing it over Zoom. By Dr. Emma Black from Cascade Live Cash Management. How are you doing today, Emma?
Doing really well, thank you. Doing fantastic, and absolutely, we could have done it in person. A stone's throw away. So the listeners will get two Geordie accents today.
So, just to clarify, when people say Geordie accent for mine, I feel like a bit of a fraud saying yes to a Geordie accent because I'm actually not from Newcastle. Live in Newcastle.
So you're an
adopted Geordie, which is even better in some cases. So, yeah. So for anyone who doesn't know, Emma, she is the CEO of Cascade Live Cash Management, which is a cash management platform for clients. And these guys are on a really noble mission to make savings simple. Now, we're doing this at a very interesting time, recording this podcast, because there's a cost of living crisis going on in the UK. Interest rates are going all over the place at the moment. Inflation is ridiculous. So it's an interesting time to be talking about this kind of asset class. But firstly, as we always do on the podcast, to kick things off, can you just, Emma, tell us a little bit about what it is that you get up to on a daily basis?
Absolutely. So, as you've mentioned, we are working hard to make savings simple. So every single day for us, we are working with customers to help them get the very best from their hard-earned cash. We distribute our service through 3,000 professional advisors. So we're often on a daily basis on lots of conversations with each advisor and their clients, trying to understand their client's journey into cash. Holistically what they're thinking about in the next steps, where they want to come out of cash, and what's going to remain liquid. How can we get that working as hard as possible for them? And then we're working also with providers. So we're working with providers to see what exclusive products we can get. Where can we streamline account openings and onboarding processes? How can we make the maturity process really slick and seamless for a number of different individuals as well as corporates and charities. So for us, it's very much a case of looking to remove the frictions that are there within the savings space, trying to enhance the rates that people can get, and trying to design solutions that otherwise aren't there.
Good stuff. I think it'll definitely be worth taking a dive into what we mean when we say cash management, because this is a bit like cash flow. When you describe cash flow to the average person, they think of like business cash flow. So they think of money in, money out. Whereas financial planners, when they talk about cash flow, for instance, they mean cash flow modeling and cash flow planning. So it means vaguely the same things, but it's like there's little nuances and things like that. So when we say cash management, to a lot of people, they'll think of it as just managing cash, almost like kind of budgeting. Some people think of it as that. Whereas financial planners, of course, we all know that it means something different in our profession and in the financial services space. So to make things very clear and to kind of just nail this down, can we just go into what cash management actually is? And also the second part of the question is, why is it needed?
Absolutely. We are so guilty in this sector of overcomplicating things and using jargon that becomes everyday terms to us. But when you speak to the people that we're serving, often it's a case of what does that acronym mean? And what does cash management mean? It sounds a lot more fancy than in reality what it is. So cash management varies, but the main practice is it's looking at cash deposits, savings accounts. Those can be for individuals, businesses, corporates. They can be for small sums of money. They can be for large sums of money. And really what you're looking at doing is you're trying to create a combination of accounts, so a portfolio of accounts whereby you want to structure in access to those accounts over time. So some people might want instant access, some people might want 3 years, 5 years, whatever that might be. So you want to structure the access to the cash savings accounts, which is what we call the liquidity, as well as then the second key component, which is diversification. So the name of the game is to make sure that you don't put all of your eggs in one basket. Your hard-earned cash is not sat with one provider because we don't know what's coming around the corner. And what we want to do is we want to look at the optimal balance between liquidity, the access to your cash, diversification, spreading it across different banks, and the overall return. So trying to get the very best rate. And at its heart, that's what cash management is about.
Fantastic. Literally, I don't think I've ever heard a better definition of anything ever. So
Academic in me. There you
that
go.
was perfect. I mean, yeah, there's also something else which is in there which we could talk about today as well, which I think you'd probably agree with, which is the protection side of it. So like the making sure that that your savings are covered by the different things that are out there to help consumers, like the FSCS, for instance, and stuff like that. That's yeah. So there's other elements
that you can look at in terms of diversifying. You can diversify across different banking licenses, but you are absolutely right. The Financial Services Compensation Scheme will protect eligible depositors, which is every entity really today, up to a maximum of 85,000 per license. There are some exceptions. So if you are a financial institution, you will not qualify for that protection. But if you've got money that is held in a pension, if you've got money that is sat there as a charity or as a corporate or as an individual, then part of that diversification is that if you've got, for example, 250,000, then you can place 85,000 per license, and within 3 banks, you can fully protect that capital. If somebody's of 10 million, then it might also be a case that over that 10 million, deposit amount, you might want to diversify and put no more than 2 million per provider, etc. So the lower the deposit amount, the easier it is to get full depositor protection. And to give context, some of our clients have got 1 account. One of our clients has got 97 accounts with us across 97 different banking licenses. So from our perspective, we will get somebody as much depositor protection as they need. But you're absolutely right. It's a key component of what we do.
Yeah, absolutely. Again, beautifully described. Lovely. And I was going to, like, the second part of the question obviously was why it's needed, but I think we've gone into that there, why it's needed, especially with that protection piece there at the end.
Yeah, I think really the 2 core reasons of why it's needed is, number one, nobody else is going to do that for you. So money that is held with banks, we seem to have this natural viewpoint that the bank is there to look after us. And really the reality is the bank is a business. So the bank is making a profit by taking in your money, lending it out to borrowers. The bank looks to maximise its net interest margin. So the bank is not going to give you information to say, well, actually, our competitor will give you more for your hard-earned cash. So therefore, the onus is on the individual saver. So the first thing is shopping around sits with you. It doesn't sit with the bank. So, if you don't shop around, you're not going to get the best outcomes. And the second one is that, we live now in a world of uncertainty. One of the constants that we've got is that uncertainty is now an everyday part of our lives. And I think the last few years in particular have proven that we just really don't know what's around the corner. So therefore, being prudent and making sure you are diversified, making sure you are accessing things like the FSCS is really, really important, because it's those things that give peace of mind. So why I think cash management is important is that people have often worked very hard for that cash. Getting the most for that cash that they possibly can is a really important thing. There's a great text called The Richest Man in Babylon, some pamphlets that were produced between the First and the Second World War. And those are great rules and lessons, just get every pound working as hard as it can. And the second one is the peace of mind. What you would hate to do, anybody would hate to do, is that you've worked really hard for your cash, you've got 100,000 to save, and something happens and you've lost 15,000. It's a lot of money for people to suddenly lose.
Yeah, definitely. The 19 accounts is probably the extreme. Well, it's definitely the most extreme that I've heard. So that's cool.
It's out there, but in the same instance, this is why when you pay an expert to do it, it's take advantage of that, because you get an economy of scale, and not only that, but we are monitoring, we've got processes and systems, and we can make sure that we stay on top of that for all of our clients. So, what this particular client views is that, he's custodian of that capital. He's worked very hard, he's got the capital, and he's custodian of it for the next generation. So he wants to make sure that it's as safe as it can be, and I think that's a great way to think about life and to think about wealth. It's ours as long as we're here. And if we make sure that we are thinking about it in that way, we can get the very best outcomes for it.
Yeah, definitely. Something you did mention there, which is kind of tied to the 19 accounts thing, is this idea of multi-banking. So we even maybe 20, maybe even less than that years ago, multi-banking wasn't really a thing. I don't know. I didn't have a bank account 20 years ago. I was only 7 years old, so I probably had like a Cumberland Building Society account or something like that. But now it's commonplace. I mean, everyone who's listening to this will probably have more than one bank account, that they've got different holdings in each, and that is just a normal thing nowadays. But that obviously must have had some impacts on the personal finances, the economy, and things like that. What impact do you see? What impact has it had on everything?
Absolutely, yeah, absolutely right. Multi-banking is kind of a new phenomenon. So if you look at financial services and if you look at banks kind of 20, 30 years ago, the current account market was the most competitive, because if the bank won the current account customer, then often they would add on additional services and products. So if you won the current account, you would add on a credit account, savings accounts, mortgages, insurance, life policies, and so on. Yeah. And over time, what we've seen is the emergence of things such as Compare the Market and other different convenient sites where it's easy to then be able to compare different products. So it's kind of an everyday thing now for people to think about getting car insurance or home insurance and to go on to Compare the Market. And because of that, what you have is that often people's, they've used mortgage brokers for the mortgage, Compare the Market for the insurance, and they end up having a different mortgage provider to their current account. They end up having their insurance being delivered by different providers. And that's something that people have grown accustomed to. So people are comfortable now with multi-banking. However, there's lots of friction still as part of that. And that's had a big impact in terms of financial services, because where the banks were upselling customers and were getting profits from doing so, now the case is that actually people are shopping around, and it's not a given that if you've got the current account, you're going to be able to upsell to an insurance product or get the mortgage. Yeah. So therefore, you've got enhanced competition, and that's gradually been increasing over time. There's certainly been some regulatory initiatives that had came about in the aftermath of 2008 to make sure that consumer outcomes are at the heart of financial services and that competition is working well for participants. So some of the impacts have been that consumer outcomes are getting better, but there's also the natural outcome in that, there's a lot of information available now. In the time frame that people have started multi-banking, technology has grown and grown and grown, and innovation and invention, we've got things available now that we didn't have available 20 or 30 years ago. And we've got innovation moving at quite a rapid pace. So people are comfortable looking at different tools and different platforms and being able to use that. But then there's that reassurance piece, which is, well, actually, although I know that I can multi-bank and although I know that there's different providers, I'm not necessarily confident in my choice of who to go with, and I don't really know what it is to do. And I speak to, friends and family, and they'll say that often it's just price. Mm-hmm. Often they don't know the difference between providers, and it's just whoever's offering the best rate or whoever's, going to charge them the least for the products is what is there. But if you speak to a financial services advisor or expert, that's something that causes you concern, because it's the blueprint, it's the little terms and conditions that people might not be aware of. So they're signing up for an insurance product, but are they protected for what they think that they should be protected for? And people sign up on the savings side. Do they realise that if they open up a fixed term savings account, they can't access it until the maturity date? And it's all those different types of things that, we very much believe in the hybrid, because we think multi-banking is something people have grown accustomed to, but actually there's still gaps in the market. And we think humans can fill that gap really well, where you can use technology, you can use tools, you can find out great options, but you can get that reassurance over who you should be going with. Are you protected for what you think you're going to be protected for? What things should you consider? And that buzzword within finance at the minute, that holistic viewpoint. So there's been a lot of impact that's came from multi-banking, albeit in driving competition, improving customer outcomes, but also leaving gaps that are there and frictions that still need to be broken down. And we very much believe that the hybrid is the way forward in that.
Yeah, and tech as well. I mean, the technology, the banking. I think I've spoken about this on previous podcast episodes, but the technology in banking is ridiculous compared to like overall financial services. I mean, technology in the insurance space, for instance, is not good compared to what is available in the banking sector. Different reasons for that. It was forced to innovate because of the banking crisis of 2008 and stuff like that. So, there's different reasons for it, but the banking sector technology is ridiculous now. It's a good summary though, really, really good. And there's also something which I can't believe that we've chosen this like period to record this podcast, because it just works so well. Because things like the pandemic, the current economic crisis, gas prices. I think I saw something literally today from, I can say his name because there's nothing. We're not the BBC. Martin Lewis on Twitter saying that like energy bills from next January are supposed to go up to £4,000 a year for the average family. I mean, that is just absolutely crazy figures. But what that does is, well, it could. I don't know. I haven't seen any figures or anything on it. We probably won't see them for another couple of years, is the impact that has on people's attitude towards savings and their behaviors around saving. What are you guys seeing? Like, are you seeing kind of more people putting a bit more away rather than being a bit kind of spendy with their money?
You're absolutely right. The cost of living crisis that we've seen, and certainly the pandemic, before that Brexit, before that 2008, the credit crisis, uncertainty is definitely driving people to hold higher cash buffers. So people are holding lots in their savings. And, there was a big spike in the pandemic because people couldn't spend it anywhere. We were locked inside. So you're naturally seeing, obviously, the housing sector go into a boom, and it's still in that boom because people were spending it on home renovations and things like that. But people are now getting used to going abroad again, and and that's starting to get back into the swing of it. But what we are seeing is that people are very aware of how much things are costing. We're all feeling, you go to fill up your car, and you can see a noticeable difference in the prices. And there used to be those only frozen horses where back in the day and back in my day, and actually this is within a few years, people can remember prices being a lot cheaper than they are now. And I think there's been a big emphasis in terms of, the likes of Martin Lewis and so on, that saving money through shopping around to reduce your outflows. And I think people have also recognised, they're paying more for energy, like you say, interest rates are going up. So as they come to renew their mortgages, the monthly payments are going up on those. If people are on floating rate mortgages, they're going up. But then there's also the other side, which is actually then the recognition that, okay, so the banks are being fairly quick where they can to pass on the lending increases in terms of the interest rate. So if I'm borrowing money on my mortgage, I'm feeling that fairly quick, but I'm actually not feeling the benefit on the savings piece. So the big six are not really passing those rates on. And when you look at that, it's looking then at the fact that the banks are businesses and looking at how do they make their money, which is the difference between the inflows they get from the borrowers and the outflows with what they pay for their savers. So those net interest margins have been squeezed. They continue to be squeezed. But in the same instance, I think people are now recognizing I need to shop around. I need to actually go out because, a couple of years back, you would look and you would say, well, the interest rates are low. Should you shop around? Well, we would always encourage everybody to get the most for every pound in any climate. But when you look now and you recognize, okay, so most people are getting 0.01%. And then the 1 year fixed term rates are paying 2.75%, 2 year rates are paying 2.9%. Some of the best instant access rates are on 1.6%. those are big amounts to be looking at in terms of what you are foregoing simply by where you are holding your cash, which provider you're holding it with. So we are finding that people are now almost being encouraged and being forced into, I really should shop around more and what is available. And we are seeing people coming to us where, you know, in the past, safety wasn't necessarily an issue for them. You know, they might have just thought it's okay. They might have looked and thought, well, you know, rates aren't that much. We are finding everybody is coming to us now and saying rates are higher. I'm not getting it from my current provider and I need to do something. So we're definitely seeing an impact coming through on consumer behaviour. And I think that's going to continue. And I would always encourage that. On the one side, there's a lot of media about shop around and pay the least you can for your energy and all those things. And I would also say there's another side of that coin, which is that any cash you've got, you know, get it working harder. And I'm sure there was a regulatory report that said every year there's something like £5 billion worth of interest that is lost because people don't shop around. They just leave it sat earning nothing. So on that basis, you know, with everything that's there, uncertainty is going to be a continued constant. Cash buffers, therefore, will continue to be there, but get them working hard.
It's great. I mean, even when you said that 2.9%, and that's when we consider that how low interest rates have been for, what is it now, like 14 years or something, maybe just a bit less than that, and that still isn't even scratching the surface on inflation. Like in reality, that would be a good investment return. Like not a good investment return, but it'd be a safe investment return for most people, 3% every year.
And it's, remember, you know, like this is the thing, like on savings with cash rates. Cash rates are not ever historically designed to give you an 8, 9, 10% return. That's why you invest. You know, so if you're getting 2, 3% on your cash rates, cash is back in the marketplace. You know, it's something that's back there as an asset class, and it's doing what it is historically meant to do. It's a risk-free asset class by all intents and purposes. So, you know, the rates are definitely back to where they should be. They're probably going to continue to go higher. How much they get passed on by the providers is probably going to be, you know, a gradual decline in the extent and the pace at which the banks are able to pass them on, just through the net interest margins being squeezed. But they will continue to creep up and up. And the central banks worldwide have made it clear they will not withstand rising inflation at the pace at which it's rising. So, you know, it's something that even rates today, they're much better than they've been in the last decade. They're not expected to go down. Rates are now up and they continue to stay at that level. But in the same instance, they're probably going to continue nudging higher for the next kind of 18 to 24 months.
Yeah. It's fascinating economics. It is. I mean, like it's cool to be living through these kind of cycles. Like, you know, you hear about them.
Yeah, we're in history.
Yeah, you hear about them and you like read about them in economics textbooks and all that kind of stuff. And then when it actually comes along, you're like, oh, we're living through this right now. And it's really cool. You mentioned there that cash is back as an asset class, which is that's a soundbite if we ever needed one, that one, isn't it? And you mentioned a lovely word before, which is holistic. So it is, you're right, it's a buzzword. And the majority of the people in the audience will likely call themselves holistic financial planners. To be honest, I think if you're calling yourself an unholistic financial planner, then that's just a bit ridiculous. It doesn't exist. But cash is often thought of as the boring part of financial planning, and the bit like, you know, building a portfolio. Yeah, we'll have some cash in there, but like the emphasis is nearly always on investments. But we all know that it is something that has to be considered, especially for people who need access to it in the short term. But how important do you think, I mean, I know what the answer is going to be here, but I just want your comments on it, of how important cash actually is and how it's been proven to be important in that holistic financial planning process.
Absolutely. So for me, everything always starts and finishes in cash. So cash tells you the journey that somebody has been on. How have they made their wealth? How have they made their money? And that's where you find out some incredible stories where people have made businesses, they've had great ideas, and, you know, and they've sold them and they've accumulated some you know, fantastic returns in a fantastic pot that they want to look after for the rest of their lifetime and for future generations. But also over time, you then look at what liquidity do you need? What access do you need? What are you planning? What are you thinking about doing? Sometimes people don't know. Sometimes they want a bit of time. They've had a big liquidity event and they want to take time to think about what's coming next. If they've exited out of a business, they might have worked 10, 20 years, and they've worked hard for that, and they want to take a bit of time to see what the next chapter is going to hold. So in that time frame, cash is a great place for advisors to be able to get the cash working harder, but give somebody the flexibility to think about what comes next. On top of that, what you get with cash that you don't get in other asset classes necessarily easily is defined liquidity. So if you have instant access, if you've got a 90-day notice, if you've got a 1 year, once you get to the end of that term, you've got your cash back. Whereas, for example, often people will look at cash and think the next best asset class to it would be property. People understand savings and they understand property. But when you look at realizing the liquidity of property, you've got to find a buyer. And you don't know exactly what you're going to realize that value at. This is the market that it could be. At the moment, it could be a lot higher than you thought. But in the same instance, it might not be exactly where you thought. With cash, you get the defined liquidity and you get the defined amount. So we think cash, in terms of the different asset classes, why people are most interested in cash is around that liquidity. And of course, getting it working harder is really important. So for us, we think it's important for all financial planners to be thinking about the cash element, because it will give them the story around the evolution of their client to their wealth. And that helps them to answer questions around AML and things such as source of wealth and all those different types of things, knowing their customer. That allows them to understand some of the drivers of customers, how they make decisions. Those things are really important for them thinking around what comes next. And giving people the breathing space to be able then to see, so while you're in cash, we'll get it working hard, and you can think about what's most appropriate for you instead of trying to push people into big decisions that they might not yet be ready for. On top of that, you also get sometimes other asset classes aren't appropriate. So if we think particularly in later life planning, and we think around cases where often property is being sold, people are looking to pay for care bills and so on and so forth. In those types of situations, is it appropriate to be putting capital at risk in any circumstance? Is it something that's appropriate for the capital to be tied up? Again, cash is appropriate in those circumstances because it allows for financial planners to be looking to get the cash working hard, but also be able to meet the liquidity requirements of that underlying client that they're serving and they're helping. Yeah. So for us, cash is important. It's naturally important. It's an asset class that people will start and finish from. And you can't really think about any other asset class without understanding the liquidity aspects of cash. So although I admit I'm biased, I do think it remains a very important asset class.
Yeah, like I said, I knew what the answer was going to be, but you've again, explained it in a lot of detail, and it's very, very clear. I think a lot of people in the audience will kind of already be realizing this, especially with their clients. And no matter how much you educate clients on the fact that this was going to happen at some point, like markets go up and down and things like that, it's just human behavior to get spooked at these type of times. So there'll be a lot more conversations around cash and, so we say, safer assets going on, and less volatile assets at the moment. On the kind of link to that, you've given tips about like shopping around and stuff like that. But if you could give the audience one tip on cash management, bearing in mind that they're financial planners, what would that be? What tip would you give them on cash management?
So for me, I would say use an expert. For me, it's a case that where you've got somebody that has an expertise in cash management, they're going to be living and breathing the sector and the space. So they're going to be at the forefront of what's going on with interest rates and what's going on for onboarding processes and for the maintenance of savings accounts, for things when they're maturing, better rate opportunities and so on. Use an expert because then they are responsible and accountable for it. It's a priority for them. Often what we see is that, you're right, cash is the last thing people think about and on that, it's often the lowest of their priorities. But actually, they're giving away thousands of pounds by not shopping around. And we've had a number of financial planners come to us, and they've spoken around how they've tried to open up savings accounts for customers, and they've thought it was quite complex because different providers on board in different ways, and they needed different IDs, and they found it hard to keep track of all of that. And on top of that, we've also been told that advisors have opened up accounts and then they haven't set maturity date reminders. So accounts have matured and then they've sat there lazy, not doing anything because the advisor has forgotten, to get back in touch. So, and that's not just true of advisors. I think, a lot of people would be guilty of that on their personal side. And of course, directors, in many companies and many corporates and charities, financial directors are often doing many different things, wearing lots of different hats. Again, are things done as quickly as they should be? Probably not in terms of cash. So if you use an expert, you get that cash working harder, but you also have somebody else accountable and responsible for its performance and making sure that nothing is forgotten. And that economy of scale, you just can't beat.
Yeah, that's a good point. It is. The maturity thing is probably the most worrying. I think that like to forget that. And then you mentioned earlier about the £5 billion lost a year in unclaimed interest, for instance. That's scary. That is very scary. Okay, so let's talk. So people might have realized that at the start of this, we have referred to Emma as Dr. Emma, and that's because she's got a PhD in behavioural finance, which is that is right, isn't it? It's behavioural finance that you got a PhD.
Yeah.
I love this question. This is one of my favorite questions to ask, or the favorite question that I've come up with to ask you. Behavioural finance is growing and it's fascinating, and a lot of financial planners do find it very, very, very interesting because it's obviously by nature it is interesting. But which area of behavioural finance do you find the most interesting, and why as well?
It's a great question, and it's going to bring out the academic in me because I really love delving into why we make the decisions that we make. And what was really interesting for me as a student of economics and finance was looking at the history of economics and looking at the different schools of thought. And when you go back in history and you look at actually a number of different economic schools of thoughts were born into they were very much interrelated between religion and economics in the early days. And today, Islamic finance is very much still the same. And you still have Sharia compliant accounts that are very much woven in between religion and economics. But in the Western economies, you started to see that divergence away from religion and economics. And in 1776, we had the Wealth of Nations with Adam Smith, which gave birth to a number of the modern day concepts, which is demand and supply and all those things. But some of the underlying principles around some of those economic theories and a lot of academic theories is based on rationality, and it's based on people behaving in a rational way and markets becoming efficient as a result of that. So demand and supply driving prices to rational outcomes. And what behavioural finance does is it relaxes that notion, and it says we are all capable of making decisions that are not rational, and we are capable of being driven by emotional factors. And as you delve into it, I'm sure I read a study recently that said of the decisions we make, kind of 80% of them are driven by emotion rather than by fact. So naturally then when you look at it, it's then a case of, okay, so we are then susceptible to things impacting our emotion, which in turn will impact us in terms of the decisions that we make. And then you delve into my particular favourite area to answer the question, which is around anchoring. So there's lots of different things that are there, but what's really interesting is if you just fundamentally look at the concept of money, how do any one of us know exactly what something should be priced at? how much does anybody know how much a cash management firm should charge for its services, or how much a Mars bar should be priced at in your local supermarket? At some point, a price is being set, and that reference point is something that we anchor upon. So when things go up, then we feel that. When things go down, we think it's a deal, and so on. But it's the reference points that seem to drive lots of decisions. And those reference points have just at some point in time been created out of thin air. But those fluctuations that we see based on demand and supply, and based on what drives people to demand certain things, or what drives the supply of certain things, is really interesting. So for me, I love delving into how do we make the choices that we do? What are the consequences for us as individuals? And then on a societal level, what consequences then ripple through from that? And kind of, if we think about those early economic schools of thought, the religion and economics being very intertwined, and certainly Islamic economics today, a key part is that actually we are part of a community. And those choices that we make with our personal wealth, and the choices that we make, in buying certain products and so on, we should have a moral conscience with that, because what we do see is great inequalities, and the cost of living crisis is impacting certain parts of society in huge amounts, and the impact on food banks and things like that. It's incredible, and we've naturally seen a rise in ESG, people starting to think around the morality of the choices that they're making, and things like that. And for me, those reference points are super important, and they permeate through lots of different things. So, for a lot of people, they will have came into adulthood and all they've ever known is low interest rates, and that's incentivized certain behaviors. It's incentivized cheap debt, so a lot of kind of young people will be used to having credit cards, or will be used to being able to get something today, that instant gratification, because it's not actually going to cost that much. In order to pay back tomorrow. That's now changing. Interest rates are going up, which is great for savers, but it's going up for borrowers too. So some of the behaviours people have got used to, they're going to change, and anchoring is going to be really important for how that impacts people. So I think it's super interesting, and I think to understand why we do what we do, and and how that can impact us all on a societal level is really interesting.
Yeah, that's so true. There's a few things in there that I find really interesting. I spoke about this again on previous episodes about the effects that the pandemic will have on the future generations and their behavior around money. So they've lived through a time where they might have had a bit more because they weren't going out and spending as much. So therefore that obviously has an impact on their behavior. But they're also living through a bull market. It was at the time where investing was actually quite lucrative. And then they come into a point where we're now going into a bear market and it's completely changing. And it's just, it must have an impact on your psychology in your head. Like it must do. So it's a really
we get told that a lot. So we set up a new savings and loans bank, and we set that up. It's received its license, GB Bank, and we set the bank up when we were in the early days of formulating what the bank was exactly going to do in terms of its product set. We did some focus groups. What was really interesting on the savings side that came back were people were saying that actually a lot of the younger generation don't understand the concept of money. Whereas, I can remember going to TSV with my grandmother, and we would have a little passbook, and we'd have stamps in the passbook, and you would get like a little teddy or whatever it would be as you saved. And you learned about that, and you learned about it in terms of kind of, you'd wash the car and you'd get however much money, and you started to learn about how it works in terms of the concept of money. And what we had fed back to us was a lot of grandparents, a lot of parents saying there's no real concept between work and money, because you just click a button and you spend, or you click a button and it comes out of the wall. And actually that connection piece between that you have to put a bit of effort in order to get those returns, that it's very easy to spend now. And actually, the younger generation being able to understand how you accumulate wealth, how you manage that wealth, that you shouldn't just click a button and actually, I've spent a lot more than I thought. Those different types of things, that money is changing, and managing finances for people are changing too.
Yeah. It's true, because it's like this idea of tangibility. Like, I can't remember the last time that I held a pound note, and that's ridiculous. Because that was even 20 or 30 years ago, that was the accepted form of all payment. And now I actually cannot remember the last time I touched even a £5, £10, £20 note, and it's absolutely great. And that's that much, like you said.
Or even if the last time that you used your card, I now wander out quite freely and I'm on Apple Pay, and yet you're using your phone. And this is why I think it's really interesting when you look at financial services and you think about the future and you think about how things are going to evolve, and the classic example that we can look back at is we can look at Blockbuster, who was given the opportunity to buy Netflix. And the idea was, what if there aren't any DVDs? What if there aren't any videos? What if they don't exist? And the idea with Blockbuster is, that's never going to happen. And it did, and of course within financial services, what if banks as we know it don't exist? What if cash as we know it doesn't exist? It's interesting that things are moving at pace, and there's been a lot of reports around whether we're becoming a cashless economy, and actually certain demographics require cash. It's actually really important for them to continue to still have access to cash. So there's a huge regulatory emphasis to make sure that people can still get access to it. But there are really big changes. And when you think about where financial services are going, anything is possible. And in terms of, if you think about invention versus innovation, invention are the things that just have never been there before. We don't know yet what they could be. But it's interesting to see, how behaviours are changing and how things are emerging. And is it feasible that cash as we know it and banks as we know it could change in 100 years? It is.
I think it's almost certain, to be honest, isn't it?
Yeah.
Especially with like things like, this could take us down a whole other rabbit. Well, I'm not going to let us, but with things like cryptocurrency and stuff like that, like we haven't even touched on it. That's the first time we've said it today. We could go and do a whole other podcast episode on that, so let's not talk about that. But something we did speak about last time we talked was the excitement about hybrid financial planning or hybrid financial advice. I use the terms interchangeably. I don't think anyone really cares about that model here in the UK. I'm excited about it as well, and the main source of excitement about it for me is the accessibility of it. So like that we could have a better educated and a more served financially population if financial advice was more accessible, which I think is what hybrid advice is trying to do. But how long do you think, two parts, why is it important to you and why are you so excited about it? And also, how long do you think it will be before we actually see it working well here in the UK?
So I remember starting my career in financial services 15 years ago, and we used to attend a number of events. And I remember at one of the events, you would be surveyed and they would ask you different questions around, what was taking place. And 15 years ago, and it's still true today, but there was big emphasis on robo-advice. And were financial planners and advisors going to lose their jobs because the robots were going to take over? And I remember saying 15 years ago that I didn't think that would happen. And actually, it's still true today. So, if we speak to investors and so on, it's still true that people will say, they think people want self-serve, and they think people want it completely digital, and I don't. And that's not what I see in the market. I think people like interacting with people. I think there's certain things that they want to be done quickly and easily. I do, naturally, if you can do that, if it's convenient, things like Amazon, yeah, of course you want to be able to just do things very seamlessly and very slick. But in the same instance, when it comes to money, when it comes to health, those types of things, if people need to speak to a human, they want to be able to speak to a human, and they don't want to have to sit waiting and talking to a robot. And I can say this with painful experience as an individual with a Geordie accent, where you're ringing up, speaking to the robots, and they're repeating back what you said, and it's absolutely not what you've said. And my technique is to get my other half, who's from Cambridgeshire, to speak, and it always understands him. So the north-south divide of the robot.
Yeah.
But it is one that I just naturally think the hybrid for me just makes sense, because I think technology, you can use technology to do things that you don't need human intervention on. So for example, if we think about what we do, how do we use technology? So we use technology to be able to combine savings accounts into the most optimal format, and that's unbiased. There's a logic that sits behind that in terms of the business logic. It's driven by the liquidity that somebody needs for the access, the diversification and protection that they want. And ultimately, it's combining those two factors to get somebody the best returns. And that's completely unbiased. There's no human intervention that could skew that, and that works great. Within seconds, you can get the best combination of accounts. It's also really useful for looking at, can you get a better rate opportunity? Can you get, maturing accounts? Having those things automated is superb, because it allows people and it allows us to do the human element, to do the customer service element, to find out the why, to find out what are you trying to do and why are you in cash, and where are you going, and all those different types of questions. And all of those qualitative aspects, those can really supplement the quantitative that a technology platform can do super well. So for me, the combination will always work best. And in my experience, I am not meeting people within financial services at any age group that are saying they do not want to speak to a person. I am speaking with people that, a friend of mine had a baby and she was opening up a savings account for the little one. And she said she was going to go into branch, and she was getting a bit stressed because she had the little one. And I said, oh, you can just do it online. You can do it, on a banking app. You can do a video call and open it if it's going to cause you stress. And she said, oh, no, I'm not very good at these things. I'd be too worried. I want to go in person. She's in her early 20s. So things like that, where actually people feel comfort in speaking to a human, and that's the same across any age group. We do what we do really well. We're really confident in that. But if it's something that we don't do every day, and when it comes to money, people have in their mind, what if I transfer it to the wrong place? What if I open the wrong account and I need to get access to it? All of those questions, that's where a human can give that expertise and that overlay. So I think the hybrid model gets the best outcomes.
Yeah, it definitely does. It's about using everyone for their, what they're good at. So technology is great at logic and algorithms and, finding out the most logical way to do something. We know that humans aren't. As you've just mentioned there, 80% of our decisions are made based on our emotions. Computers can't do that. So there's no way that human element can ever be replaced. And I think to be fair, our profession's come to terms with that now. And I don't think anyone really thinks that robo advice, in the terms that it was described, when it was originally formulated, will really work. I think there's a human element that's always going to be needed there. I think I agree with you on that. Well, we're coming near the end now, and every single second of your time is precious. So I don't want to take up any more of it with unnecessary questions. So we'll start to close things down a little bit now. Couple of questions that we do like to ask everyone. So we always like to ask our guests for a book or a piece of content, or I changed it recently and I've been asking people for a film if they have one, or something like that. Basically anything that has helped you or really left an impact on you that you'd recommend our audience consume.
Yeah, absolutely. So I'm going to do one that I sadly lost my father early in the year, and he was a huge fan of books. He had an obsession with books. He's left us with thousands and thousands of them. But just before he passed away, he left me with a book called Ikigai. And it's an incredible book. And it's around the Japanese philosophy of why do we get out of bed every day? And thinking around what our purpose is. So what we do is we can think about what are we really good at? What does the world need? You know, what can we get paid for? All of these things. And where you get those crossovers, you can then look at what your mission and your vocation is in life, and it leads to a really happy life. So I would say the one that really embodies for me of, you know, where we've got a finite amount of time here, you know, is the reality. So we should enjoy it. We should be doing something that leaves the world a little bit better for us having been here. You know, and I do subscribe to the idea that we are custodians, because everything that we've once come to own will be somebody else's at some point, you know. So if we can think about our ikigai and we can think about our purpose for being and all those different types of things, it's a really great way to spend your life. What a fantastic thing that people can say, and I certainly can, that you get out of bed every day and you love who you work with and you love why you do it, and you know, you're helping others and you're leaving them a little bit better for you having been here. It's a fantastic thing and a fantastic bit of peace that you can give to yourself.
Oh man, you every time you bring something up, I want to just talk about it for hours. So it's like, because I could, like, everything you just said there, you know, is completely true. Like the difference that doing something you love makes in your life is crazy. Like, you don't spend your life wishing for something else. You just find yourself enjoying yourself all the time, and it is a really, really cool way to live your life. I agree with that. Great stuff. I don't think it's ever been recommended before as well, so surprisingly, but yeah, it's a good one to get on your bookshelves. So thank you so much, Emma. It's been a pleasure chatting with you. I thought it would be good, but it's turned out even better than we imagined. What we do like to do is we like to give the last word to our guests to say a big thank you for coming on. So if you could just let our audience know how to find you, where to connect with you, and if you've got any final thoughts as well to close off the podcast.
Thank you so much. Thank you to everybody for listening as well. You can find us on LinkedIn at Cascade Cash Management, Dr. Emma Black on LinkedIn. We are also on Twitter and Facebook at Cascade Cash Management, and we regularly share content on there. We also have a savings hotline, so 0800 054 1414. So if anybody's got any thoughts around, you know, what they want to do with their cash or how they can get the most from it, feel free to give the guys on the savings hotline a call, and we'd be delighted to help.
Great stuff. What a way to finish. Well, that was a really good episode with Dr. Emma Black from Cascade Cash Management. If you enjoy this podcast, you can listen to it, of course, as you probably already are, on Spotify, Apple Podcasts, and Google Podcasts, so you can share it with your friends. And it's also available on nextgenplanners.co.uk. And on our website, you'll find more information about our training contract, advice stack, our amazing community, which now has over 800 fantastic financial planners in there, and our conference, which is coming up in 2023. The person you've just listened to, Dr. Emma, was part of our conference in 2022. So that tells you about the level of people that we have. And that's going to be amazing next year as well. We're also on social media, so you can find us on LinkedIn, Twitter, Facebook, and Instagram. And as I always do on these podcasts, I'll eventually promise TikTok at some point in the future once we figure out what we're going to do on there. And if you could just leave us a rate and a review, just to let us know how we're doing. You have no idea how much that helps us as a podcast. But for now, that's all from us. Thank you very, very much to Dr. Emma for coming on the show today. Thank you guys for listening, as always. And we'll see you in the next one. Bye-bye.